Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. I'm joined once again with my good friend Doug Heagren. Hey, Doug.
Hey, Kirk, how you doing this morning?
I'm doing great. A little spicy, little this, a little that. It's a weird day so far, but yeah, let's kind of dive right in. This has been a really interesting week in this past. Earnings have started. You start to see a lot more volatility in the market. Volatility, i.e., it's just gone up, straight up. But we're going to kind of dive into some of that and a lot of stuff we're seeing because I think what we've seen on this, what we talk about in the show, we certainly centered around a lot of the big developments that are going on in the world, like housing, interest rates, inflation, and a lot of those metrics have started to change. Now, I want to bring up a few topics today. They're really important and they will help color the direction of the markets going forward. And I'm just going to name them here and we'll kind of go through them throughout the show. So one thing that actually happened in the last, I think it was 2 days, is Putin decided that they no longer wanted to honor the agreement with Ukraine getting the grain out to the rest of the world, and that is potentially significant. And apparently they attacked a port with about 68,000 pounds or tons of grain. Right now, none of that means anything to me. I don't care the numbers, whatever. It doesn't matter. The point is this is potentially a significant shift in the markets. And subsequently, I think grain prices went up like 5% immediately. I'm not sure where they are now. I'll have to look them up. But the point is you have a factor like that. The Ukraine war started. People were thinking, oh my God, we're going to have hyperinflation. The food prices are going to go through the roof. People can't find food. There's no better way to start a global war than to cut off the food supply to the whole world. And Ukraine is the breadbasket of Europe, and that would certainly cause a lot of problems. Now, it makes me wonder about a war sometimes when the war has rules. If a war has rules, it's not a war, it's a negotiation. And I heard this in some podcasts, so I'm not going to take credit for that. But I thought it was an interesting mental model to think about, right? The U.S. and Russia are basically de facto at war via Ukraine as the proxy. We're not technically at war. Russia's at war with Ukraine, but Ukraine's not supporting itself. We are, and so if you really think about it, like it's a negotiation over whatever terms. I don't know what they're fighting over, but there's something they're fighting over, and it's negotiation with weapons, and a lot of people are dying, and I'm not minimizing that. But if there's a war, there really aren't rules. If you want to win, you're not saying, oh, I really want to win, but I can't attack that guy because that's outside the rules. If you're fending for your life, you're not worried about rules. You're going to do whatever it takes. And that's why war is ugly, war is messy. Nobody wants a war because there are no rules. So I just point this out because I thought it was an interesting take on war and battles that we've seen. We in the U.S. don't get exposure to this because we have Canada and Mexico, and outside of the war on drugs or the cartels, there's no fighting going on in our parts. Now in Europe and Ukraine there are, and of course that impacts a lot of people in real ways, but we don't see it over here. It doesn't impact us. I think September 11th was the closest we saw, and that impacted people very significantly and colored our the rest of our lives because of that. So I point this out because we're talking about Russia and Ukraine, and Russia just basically ended the ceasefire on grain, which will have a global impact on grain prices, good and bad. Right? There's some. It's good in that it will raise grain prices for the farmers. Overall, it's bad because everyone's going to have to pay more, and it could be that some people don't get grain because there's not enough to go around. So, we talked about 9 months ago, we started talking about the bullwhip effect. And just to remind the listeners, the bullwhip effect is effectively what happened during COVID, right? And we used lumber as as kind of an example, where you look at lumber and the prices were relatively low. I think they were like $200 to $300 range, and then they went up to like I'm just actually going to pull it up here so I can actually show the listeners. Hold on, LBS, I think is the symbol. It does not exist. Okay, I'm just going to speak from speak from memory. So basically, if you look at lumber prices, they were low, and then COVID hit, and lumber spiked up to somewhere around like, you know, $500, and then the prices went down, and then the price went up to $700, and the prices went down. Then it went to $1,400, and then the prices came back down. And I mention this because what happened was the prices go up and down because of supply and demand, right? If prices are $250, a unit for lumber, and it goes up to $500, well, that's double. Like, I'm gonna make as much lumber as I can because I'm getting a lot more for it. And now there's an overabundance of supply, so then there's not enough people to buy it, so they're competing, so that shoots the prices down. So the price went down to like 200, and then now there's not enough supply because people stopped producing because there's too much of it. So the price go up to $700. Well, I'm going to produce as much as I can at $700, right? And now there's too much. So then it goes back down to 200, 250, and then it goes up to 1400. So this bullwhip effect, cause and effect, happens because you have a misalignment of supply and demand. And normally, in normal conditions, the alignment of supply and demand is a very narrow range. It might go from like 200 to 220 to 190, but it's in a narrow range, and that doesn't cause a whole lot more production or a whole lot less. It's just, it's more of just dynamics of the market, of who's buying, who's selling. We have these big swings like egg prices from chickens. I mean, egg prices went up like 10 times what they were, but now they're back down. You don't hear people talking about that anymore. But that is because of these dynamic shifts that are going on. So we talked about inflation months ago, about how that's impacting the markets. And we saw huge inflation. CPI went up to not quite 10, but just shy of 10 in the nines. And you could argue whether it was higher. I'm not going to sit here and argue. Some commodities and goods were higher. They were 30 or 40%, and some were less. So as an aggregate, the CPI, I think, hit a high of 9.3, 9.1, I think the memory was, something like that. Anyway, but now it's down to 3%. It went from 9 to 3. And by all metrics that I'm looking at, it could go down to 2.5 or 2, or maybe even 1 or 0. We posited on the show of how it could go to 0. If real estate prices drop, it could very well go to 0. But without that, it's probably going maybe in the 2s. But now you've got this Ukraine thing going on, which is going to shoot up the price of ag. Now, ag's going to be more expensive, which means the food you buy in the store is going to be more expensive. So that is going to balloon up the prices. You have oil prices, which have kind of sagged right around the $70 range, $70 and change range, which I think is probably 65, 70 is probably where it should be. If you look at that and say, okay, that's great, unless they come out and they stop and they say we're going to stop pumping out oil, or an oil pipeline blows up or something like that. Like, all these big dynamics that shift the balance of power of the supply and demand will cause ripples throughout the economy. So I don't see it now. The inflation is dropping and continuing to drop. It's even looks like it's surprised lower at 3. Nobody was really expecting 3. But the Fed funds rate still 5, 5.25. They're expecting to raise it I think it's next week they're meeting. But in July they're going to be supposedly raising it, which, give or take, maybe it'll happen, maybe it won't. I think there's a higher probability they will, or they would come out and moderate it and say, no, we're not. So I think they're probably going to raise it 25 basis points. They're claiming they might sometime in September, October as well. Who knows? Point being is they're still afraid of inflation. You look back in the 70s, this is what happened. Inflation went up, they fought it, it went down, they dropped rates, it went back up again, then they raised it, back down, and they went over and over and over again, and they're trying to stop it, which is why my thesis is we're going to keep rates higher longer than most people think. And I don't think that that's going to change in the near term. I think the only way that they stop that fluctuation is by keeping rates high, which is my thesis of what they're going to do, and it seems like that is the case. Now, if they get 2 years of low inflation, or if they get like severe deflation, they might change that. But overall, the economy seems to be sound with 5%, so I don't see any reason for them to change it. I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true, you can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today. Now, there's a lot of other dynamics in here that are going on, but I wanted to at least set the groundwork for some of our conversation today because we're going to be talking about a lot of different issues, valuations in the market, where we think things are going, what's going on in the world of housing and all that. So, Doug, why don't you kind of pick out some of these topics and why don't you take a run at some things before I get back on my soapbox?
Yeah, so sounds good, Kirk. And I think one thing that's you really make a very, very important note on what's going on with the grain prices in Ukraine, because even though inflation has gone back down, they don't tend to count energy and food and inflation prices, right? So there's a number, and I was trying to find it, but I can't find it. From years ago, even when we had low inflation, they had some people had run some calculations, say, well, if you extract out of inflation only the things that you need, right? You need clothing, you need shelter, you need food, and excluded the discretionary items that any person with a regular budget is going to, and gets in a tight situation, they're going to exclude those things. They're going to stop paying for them and get back to those, those necessary goods and services. And guess what? If you do that, then the actual numbers for inflation, at least, can be much, much higher, because it's hard, and this is where the food issue is going to really hit people, even if they come back and say 2-3%, whatever that might be. And housing might go down. But again, if you're not buying a house at that point, it may not be affecting you. But food prices definitely do. And I think that's something we really have to continue to monitor and look at, because of the tremendous impact that has on people's budgets and their quality of life. Going into transition here about where you were talking about, I mean, we have seen some volatility reach in recently. It was just a couple days ago that the QQQ was trading 25.5% above the 200-day. Usually when that happens, we tend to have a pullback, and look at that. We have. This is the second highest reading in 10 plus years. And the highest was a touch above 29% in August 2020, after the Fed cut rates effectively to zero, and then launched a massive QE, stimulus checks, et cetera, all of that. So, where does that put us right now? Well, I know I did see the other day that we love to joke about this, but Warren Musk, I almost said, but you know what? Just group all the billionaires into one category. I heard Elon Musk had just a terrible day, a $20 billion drop in his net worth, which certainly put him on the food lines soon. But I mean, Tesla has been one of those darlings that's been carrying the markets recently, and obviously they've seen some things pull back. I did see an article that just came out. I don't know if you saw this, Kirk, that Netflix has found success in their bottom tier ad-based subscription model, so much so that they just announced that they are going to eliminate their former basic option. So they're grandfathering some people in, but I mean, anybody new trying to get onto their platform now is no longer going to be able to have the basic non-ad service. So so again, that's once again driving up, some of the costs on, that even though this is not a necessary good, let's face it, entertainment is something most people try to keep with. And so, tech has still been driving the majority of this market. And I know their numbers haven't necessarily come in very well, but I also saw that they, some context that, now we've got a writer's strike happening, and that's been going on, and how that may hit Hollywood, your traditional movie entertainment, more than it's going to hit, the streaming companies. So then again, that might be another bump there. But if we kind of look ahead at where these numbers and valuations have been floating, Hussman did, John Hussman, PhD, put some pretty good charts out there and evaluations. Actually, just came out and said, look, where the S&P 500 is, and I know Schiller has, has some charts that he, some gauging that they do on the markets based on this, but effectively looking at 10 years ahead. Where are we on our market valuations? Well, if anybody doesn't think there's risk out there, and I know that we have been lulled into this just endless perpetual greed, because it seems like every time something happens, something else occurs. I mean, even after the .com, we had real estate, and then after real estate, we had QE, and then we had things rise, and then just they've been continuing to rise almost, unaffected now since since the late since the 2010 and beyond. Well, if you take a look at this thing we like to talk about, the reversion to the mean, this pendulum swing, based on where the markets currently are, and there is plenty of data to say that they are overvalued against fundamentals. There is roughly a 10-year outlook of, above Treasury returns, which of course Treasury is not good either, as he points out, is that we're looking at a negative 7.2% equity risk premium on the S&P 500 over the next 10 years. So, I mean, that really means that, again, you could explain this, maybe in a different way, Kirk, but you're looking at over the next 10 years, putting your money in places where you can, achieve a return compared to what they call risk-free. Where's your money not going to lose money, where you can effectively lose it. And they're saying that it's going to be negative 7.2%. And that's an incredible amount of risk that is now being projected in a forward-looking outlook, and is the worst projection in U.S. history, next to March 2000 and August 1929 bubble. Both of those didn't really precede very good situations that occurred within the next couple of years after that, Kirk, if I can recall correctly. And the other thing to think about is we also was looking at kind of where, active managers, and there's been there's a difference, I believe, between active management and, active managers with regards to, how they follow things like mutual funds and stuff like that. But listen, last year, active managers had less than 20% exposure to equities when the S&P 500 was down. And now that the equity exposure, now that the markets have gone up, equity exposure has jumped to 90% with the S&P 500 at 4,500. It was at 3,500 at that point. That's the highest exposure since November 2021. Not looking that far back, indeed. But if we start looking at these kind of numbers, where just technical valuations are, with regards to the pricing of the markets, we look at the incredible exposure there is correlated to where the markets are right now, and the flow of money back into equity exposure at a peak of risk. And then we look ahead at some other things like price to earnings ratio. Everything is extremely elevated. We are now also looking at levels last seen at the .com bubble. Okay, so every time we've gotten into situations, with the exception of around right between 2003 and 2005, and really kind of looking at just that kind of really preceded running into the recession of 2008. But really taking that out of the equation, generally speaking, when we've seen this level of price to earnings ratio, we have really looked at, unfortunately, in many cases, a preface for an upcoming, pullback, if not something more extreme like a recession. Now, we've been talking about recessions for 2-3 years. We thought 2020 was going to cause that recession. People talked about us being in a recession right now, Kirk, obviously, with what was happening here going back into 2022. Obviously, there's lots of talk out there. This was the shortest and most painless recession ever, if we are truly indeed in one. But there has not been an erosion of many of the risk factors out there that I think people need to be aware of when it comes to just looking at what you're buying, and is what you're purchasing or what you're sitting in at a good valuation historically. There are things that can lead to this being the new reality, and maybe this is low compared to where we could get. But even though history doesn't repeat itself, I think going back to what you talked about with wars and talking about kind of what's gone globally. I mean, what's going on right now with the United States and Russia is a new version of the Cold War, right? Here we are. We don't want to battle each other, so we're causing chaos in places like Afghanistan and Cuba and other places to try to mess with each other. It's very much like it feels a lot like the Cold War again. And I think it's just a reminder. History isn't indicative in the past of the future, but it certainly does tend to repeat itself in many cases. And I think if you start to look at some of this data in the markets right now, I think even though it was great valuations last year, we're back in an area of risk premium, and I think people have to be very careful.
Yeah, I couldn't agree more, Doug. Yeah, I'm gonna share some charts here because I think they'll be instructive as we kind of go through. So the first one I want to show is the Case-Shiller home price index, and the reason I point this out is because I want people to really see what is actually happening with the Case-Shiller home price index, and this is the year-over-year change. So basically, it's what it was compared to the year prior. So if you look at basically low of 2008, where it was negative like 13% a year, and then you go back up to 2014, it went up to 10. And it's just kind of flatlined at 5% a year. Which, if you look back historically, real estate tends to match the rate of inflation, give or take a percent or two. But it's pretty clearly similar. So it's good going on a good clip, 5% a year until 2020, then spiked up 20%, and now it's back down to zero. So I think based on this chart, what we can expect is probably a more reversion to the mean trade, as we will, which means that real estate prices should probably go back down, maybe even negative 10 or 15 or 20%. Probably not 20 because it's like a pendulum, right? It goes, and actually this is a good lesson. Let me just use this as an example. This is a good lesson for any financial market. There's a concept called reversion to the mean. Now, what that means is looking at this as an example, right? Let's say you're looking at zero as the mean, and I'm using this chart illustratively. Whatever it is, right? Let's say the mean is 0%. So in any given year, real estate's not going to change one bit. In 1 year, it goes up 20%. Well, it doesn't just stay at 20% a year, right? Because that's a 1 year bump of 20%. Now we can see because of COVID, we had a 20% bump because people wanted to move out of the city. They wanted to buy homes in rural areas away from people, whatever it was. Like people went and bought the homes of their dreams and home prices shot through the roof. On top of that, they got plenty of cash from the government and low rates, and people just spent all that money, right? That's a one-time spend. So what happens? Now you have the home price index, let's say it was at 100. Let's use numbers. Let's say it's at 100. Now it's at 120 because that's the index value. It went up 20%, so it's 120. And now, is that going to go up another 20%? Well, probably not, because that's not a realistic jump. People have already spent the money. They're not going to go spend more. Real estate prices have already risen, so people can't afford it. So what happens? Well, people spend less because they don't have more money coming in, which means that it's either going to drop down to zero or it might go negative because 20% or the index value of 120 is no longer viable, right? Because people can't afford 120. And maybe the only reason they could afford 120 was because they got that extra cash, but that cash is gone. So they're basically still living on their savings, which means they go back to zero. However, what happened is people overspent in this high point, which means it doesn't go to zero, it goes below. It might go to negative 10. So you might get a negative 10% growth. And then things might get really cheap and then it goes back to zero. So you have this balance wherever that equilibrium or mean is. If you go too extreme in one direction, it'll go too extreme in the other direction and slowly balance out in the middle, right? It's like a pendulum, right? You swing a pendulum, it goes one way and then it goes back. When it comes back, it doesn't go all the way to where you started. It goes back to a lesser degree. And then slowly kind of gets back into the middle. That's what that's what happens with the markets with volatility. You think of it as like a pendulum. It acts the same way. It goes one extreme, the other extreme, back and forth, but slowly declines till it's a little bit more moderated. So I use that as an example because I think it's really important for people to understand conceptually all markets work that way, right? We talked about the bullwhip effect, same thing, right? It's not exactly the same because the bullwhip actually gets greater, it expands, but you still get this violent back and forth to different extremes because it's the supply and demand balance is off. Now, this chart here is actually an example of inflation. I wanted to share it because we don't really talk about it much because no one else talks about it. But I wanted to share it. It's called the PCE, so the personal consumption expenditures. And this is actually what the Fed looks at. So now the whole United States uses the CPI as the measure for inflation. The Fed says, yeah, that's great, but we use the PCE. Why we don't use the PCE for this country is beyond me. But anyway, that's irrelevant. So what I want to show here is that if you look here, it's generally kind of moderated. It's been pretty even. This goes back to the 70s where it got as high as, probably 14%, somewhere thereabouts. Didn't get up to the 20s other people did, but it was generally pretty high. In the last like 20 years, it's been a lot lower. It's been somewhere between 2 and 8%. It spiked below twice in 2008 or 2009 technically. It spiked below, and then 2020 it spiked below. And then 2020 it also spiked through the roof and went up to like 30%. But that was just a blip. So right now it's still high. So if you want to know, like the CPI is down to 3, maybe next month it goes to 2.5 or 2. I would say maybe 2.5, maybe a little bit more realistic, but who knows? I think those indexes are kind of managed. So let's just call it 2.5. Well, that's great. But this still shows up at 6. So the PCE is still 6, and the Fed funds rate is 5, 5.25. The Fed is looking at this. They're saying the PCE is still high, which means they conceive inflation as still being high. And so if you want to try to read the mind of the Fed, look at the fact that this is the measure that they consider the most, that has the most weight on their decisions is the PCE. So if you're looking at this, yes, inflation's coming down for sure, but it's still high. And it's not close to the measure that they want it. So until it gets there, we can expect that they're going to have high rates for longer than most people think. And this is what we've been telling you on the show for the last few months. And, Wall Street's actually starting to come around to our idea. I've heard it for the first time last week of, we're going to have rates higher than longer than most people think. People weren't saying that 6 months ago when we were, but they're saying it now. And I think that's more aligned with the truth. I want to just share a few charts here. One, which I thought was interesting, was the federal surplus or deficit. It's generally, we're always in deficit, except for the late 90s when we had a lot of factors that contributed to a surplus, but generally our country doesn't run a surplus. And during 2020, we had a huge deficit, right? In comparison, before that, it was like negative 400. I'm just using numbers in billions, but 400 billion. And then it went to 4 trillion deficit. And then it went back to a little under 1 trillion. And now it's down to 2.2 trillion. Enormous deficits, enormous. And it's spiking back down. So it did hit a high and now it's spiking back down, which means we've got huge deficits. So I just point this out. I'm not going to get into what that means because I'm not going to put everybody to sleep. This one I thought was funny, where Janet Yellen came out and said there's no signs of a recession on the horizon, and this is
that she had mushrooms at the time, I think.
Yeah, edibles apparently. She's something else. But I saw a funny meme last week, which actually showed like a lot of the government officials in the last 40 years and what they've said. And it was like right before the crisis, all of them said the same thing. It's basically no signs of recession. Bernanke, Greenspan, Powell, Yellen, like all of them have said this. And it's like it's like a tell. When you hear a Fed chair or a Treasury secretary come out and say, "We're not afraid of this. This is going to be okay," that's when you should be afraid. Okay, because their job, in large part, is the same job as a CEO. The CEO's job for publicly traded companies is to be a cheerleader. And I know they have other jobs, and I'm not minimizing them because their jobs are important. What I'm saying is one of their big jobs is being a cheerleader for the company, right? They don't come out and talk about other companies. They're talking about their company. It's their company, right? They're the CEO. So they're a cheerleader for their company, right? The Fed chair is a cheerleader for the banking system and for the country. The US Treasury Secretary is a cheerleader for the banking system and the country and the economy. That's their job. So when they come out and they start cheering, everything's great, like Warren Buffett did at the bottom of like 2008, he's like, I love the U.S. economy. It always goes up, and I'm going to go buy. His job was to cheer on the economy to pull it out of the recession. That was his job. He did a great job. Other people did it too, but they were acting positively in the middle of a crisis, and people were like, wait, why is Warren buying? That guy's really smart. Maybe I should pay attention to him. And then other people started buying, and other people started buying, and it caused the reflexivity of bumping the markets back to a positive trend. So if you look at these signs right before like recessions, when these Fed chairs have come out and said no signs of recession, it means they see a recession, and they're saying that because they don't want a recession to happen. So
Kirk, you know what it reminds me of? So I lived in Colorado, and in Colorado, the winter in the mountains starts well before the winter in the back down at elevation, and we would be driving up in the mountains. As soon as you get past the Eisenhower Tunnel, you get to the other side of the Continental Divide. Many times there would be ice on the road, and you'd see all these SUVs flying, and people think that they're in an SUV. It's just, they think it's got claws on the road. It's not going to go anywhere. And you'd see all these SUVs flying past you, and you'd go about 5-10 miles, and the same SUV you saw passing you was slid off the road and crashed on the side. I saw it all the time. Like, I see them pass, and there they are. And that's what it reminds me of. None of these SUVs, even though there's ice on the road, none of these SUVs, I'll bet, right before their car crash, saw the car crash coming.
yeah.
There was plenty of signs that you might not want to go 85 miles an hour on a 15% grade. But you know what? They all came back and said, yeah, we don't really see any signs of a car crash. Well,
So yeah, no, I appreciate that, Doug. So I want to make one more point and then hand it back to Doug. So I think, the reason I'm saying this is, we talk about a lot of things on this show that are inherently bearish. And I feel like I'm a perma bear on the show, and I'm not, right? And one thing I've said, and I'm going to reiterate it here so people understand, because I do get a lot of comments back from listeners about this, is that we do talk about bearish because we're trying to alert you of the danger. We're not doing it because we think the world's going to end. The world's not going to end. And if it does, what are we going to do about it anyway? I can't go anywhere. I can't go to Mars yet, right? So it's not something I concern myself with. But if you think about some of these factors, now this tweet was pretty funny, which is why I shared it. She said no signs of recession. The narrative says keep looking. But the data point was a bankruptcy surge. It says first half of the year, second half of the year. If you look at most years, it's somewhere around like 500-600. Right now we're at about 350 in the first half of the year. So it's just the first half of the year is really high, and it's a data point that says, okay, U.S. businesses are failing, and at a fast pace, the fastest pace since 2010, according to this metric. So I just pointed out because we tend to be more cautious on the show because we're trying to alert you to the danger. But we've also said on the show that if we're in a 70s kind of environment, what that means is not that the stock market's going to go down, because we all think recency bias is a mental model we all have. If the stock market's going down, we think it's going to keep going down. Even if it goes from like 10,000 down to 1, we're like, it could still go to 0, right? Like, you're always going to have this thought of it could always go lower. And yet it doesn't, right? At some point it turns around and everything's fine. We don't know where that point is, and we never do, right? And it turns around always before the data shows it turns around. It just gets to a point where people are like, I'm sick of selling, I might as well buy here. And enough people do that, it boosts the stock market. And then other people are like, oh, we're going to chase this. There was a great Wall Street cartoon I'll try to share on the website here of of the buying and selling of crowds. It usually starts by just people following each other, just like a bunch of lemmings. And so we just point out the dangers because at the same time the market's up a lot. The S&P is up 15%, the Nasdaq's up 30 or some odd crazy number, and in part because it started at such a low number. We were within a range. This January 1st, it was at the low end of the range. And then the market has pretty much gone up for most part of this year. So it's like, wow, it's gone great. It hasn't done great. It's at the high end of the range, and it broke out about a month ago. So a month ago, I would say yes, we're back into kind of a bullish trend, even though 12% of that was from January 1st. It also was down from prior years. So I kind of look at it as an aggregate and say, all right, within the range. Now we're above the range, so we're in a bullish territory. However, you look at it and you look at this data point, which Doug talked about, which is from Hussman. Great data. You probably put most of you to sleep, but for people like Doug and I, we love this stuff. So great data point. What it shows is basically valuation. So it is talking about the total return of the S&P in excess of Treasury bonds, or the risk-free rate, as you would consider. So what this chart is trying to show, and I'm not going to spend a lot of time just dissecting this because, like I said, this kind of puts people to sleep. But what it's trying to show is you want to be in the upper right, not the lower left. Right now, we're in the lower left. Because really what you want to see is you want to see, hey, there's a lot of high expected returns year over year in the future. Right now, we're negative 7.2, which is not the lowest in this chart in the last 100 years. 95 years. Sorry, a little light on there. In the last 95 years, we're not at the lowest point, but we're pretty darn close. We're maybe the third lowest point. It's hard to look in the chart, but somewhere thereabouts. We're pretty darn low. So out of those, whatever, hundreds and thousands of data points, it's the third lowest. What that means is you should have very low expectations going forward of the markets producing a positive return for the next 10 years. That's your expectations. It should be that you should not expect high returns over the next 10 years. If anything, they should be negative returns over the next 10 years. Now, this is hard to see because people are looking at their returns and saying, I don't understand. My account, my S&P is up, 15%, and the Nasdaq's up, 30, and Nvidia's up, 5,000% or whatever it is today. It's up maybe 100, but my point is you've got these crazy numbers, and people are like, it's going crazy. The market's awesome. Like, is it? I'm not so sure. Because if you look at it, and I'll share a data point that Doug mentioned as well, is if you look here at the percentage share of the market which is attributed to certain stocks. So here's a chart. The weight of the top 10 stocks of the S&P 500. 31.7% of the S&P 500's returns are due to 10 stocks. Now there are 500 stocks in the S&P 500. A third of the return of those 500 stocks is attributed to 10. What are those 10? I'll bet you can guess. Fang M, the Magnificent Seven, whatever you want to call them now. Everyone's got a big name for them. But basically big tech, plus Tesla, I think. Well, I guess they're tech if you want to put them in that category. But and so if you look at the earnings contributions, it's not, right? It's 21%, right? The earnings contributions have come down since last year or 2 years ago. So the point is there's a big discrepancy in this difference, right? On one side, you've got a handful of stocks making up the returns, the vast returns and performance of the S&P 500. On the other hand, the earnings are low. So I just point all this out because we're at a point in the market where you should not expect this to continue. If anything, you should expect it to revert back to the mean, which we talked about, which is maybe half the performance we got this year, which traditionally in 30-year presidential cycles, typically the second half of the year is a laggard or a flat part, but it's typically not a good part of the year. So now's the time I'd be a little bit more conservative and not take a lot of risk. But after the first half performance, I can guarantee you people are going to jump in with both feet and saying, all in, push them all in. I want to go, against the house. And it's just not a good time to do that. So Doug, additional thoughts?
Well, those equity managers already did, as that chart showed. It's like, it's like, ooh, look how it's doing. Let's get all exposed. A couple things that I was thinking on this. I mean, so we're not, when you talk about the risks, and you just showed kind of the bankruptcies and where we are in the first half bankruptcies is almost equal to the entire year of bankruptcies the last couple of years. So I mean, where's it going to go for the rest of the year? Who knows? But I doubt that's going to be the end of those. So it's probably going to end up a very high year of bankruptcies. So that's a sign of a risk. It's a data point. Another data point is you just talked about inflation coming down. Well, yes, inflation has come down in general, but perhaps what's going on with Ukraine is going to drive food prices back up. And the other thing that while we were in high inflation the last couple of years, we've talked about this before, we didn't necessarily have to, people that were straddled by debt didn't necessarily have to pay on some of that debt, and because of some of the reprieves that they got during, based on COVID, and one of those was student loans. And so, guess what's going to start happening here? As we said, those monthly payments are going to start. So yes, maybe cost. So the inflation went down. So what they were paying on went up, but there's a chart here from Bloomberg that's actually was put out by TransUnion that shows that the distribution of student debt, expected payment on federal student loan payments, roughly 50% of the people out there that have student debt are now going to see an increase in their payment per month that they have not had to pay, from roughly about 15%, or about $200 to $300 increase. And then of that 50, the remaining 35%, you're going to see $300 or more, with more than 5% of people out there, families out there, having now pay over $1,000 a month. So yeah, inflation may have come down on everything, but that does not replicate cash flow, or does not represent cash flow. And so if overall inflation came down by 50% of where it was, okay, and maybe that reprieved $500 a month it cost them, now you add another $1,000 a month into their budget based on student loans, you are now looking at a situation in which they're not going to care that inflation came down, because it's all about cash flow, and they may have less now that inflation is lower than they had to spend when inflation was higher. You take that a step further into a breakdown that TransUnion talked about added debt. So consumers with student loans also added additional debt. They weren't paying on their student loans, so they kind of supplemented that with new debt that they were taking on. Over 50% added more bank card debt. Just under 40% added new auto loan debt. And these were at what really expensive auto purchases. We knew the prices went up there, so that's a lot of additional debt taken on auto loans. Retail card debt. So even though bank cards and retail cards are both credit cards, right? But now going shopping on consumer goods, retail card debt, 35% took on new retail card debt. Mortgage debt, something we've talked about, just under 20% took on new mortgage debt, and just under 20% took on new unsecured personal loan debt. So for many of these families out there, this inflation number is absolutely meaningless, because you can take the price down on their energy. You could take the price down on their food for a while. You could take the price down on the next goods they're going to buy. They're still servicing the goods they already bought. And they're also going to still be servicing those student loans again. And where does that represent things? Well, we know that housing got expensive. We know that living got expensive. Well, the rent growth is potentially in trouble. We've actually seen U.S. rental vacancy approaching the highest point in 5 years. That means that the people that need to rent aren't affording that. And for whatever reason, that may mean they built new rental options that are just not being rented. It can also mean vacancy on existing. And there's some data coming in that there's concessions starting to go into the rents on especially on new apartments, the top 11 or coastal areas, and then throw in my city, Minneapolis, right there, smack dab at 6th on the list, with average days free, 30 to 45 days free, free that they are offering in concessions to get in. That's telling you that they're having a hard time renting. And this is a rippling effect, because if you're a landlord and you own these properties, you need to have people in there paying rent. People love to talk about real estate being you don't have to work for it. You have to work really hard for it. And it does have a risk when we start to see that these places not being rented. Rents are just, we're showing just high of their record high in June. So they're adding these concessions in not finding that they've got people to fill them. And they're still, and this is coming off of some of the highest rental prices. So there's a softening going on there. Now you go in and look at the people that have been trying to float all this debt, that are starting to see this increase in cash flow challenges. And there's a new report that just came out. CNN just showed 21.8% of those that applied for credit in June have been rejected. That is the highest number of rejections for new credit since 2018. And for a lot of those individuals that I just talked about, the reason they took on extra debt over the last couple of years, when they weren't paying their student loans, they added these personal loans, these consumer loans, these auto loans. They're financing their consumption with additional borrowed money from others. And now they're starting to get rejected. So we've got tightening credit availability, tightening cash flows in the household. We still have houses supply that is, that is limited. Houses aren't coming available. We are now seeing people not necessarily taking on rents. We're seeing an incredible increase in the number of Airbnb and other short-term rentals that are not being able to rent those places. Though some of those are major companies and corporations and investors that have bought up these places, but a lot of these are just everyday individuals who are just trying to do them, make themselves better. They're working a job, they bought a second home, they're trying to rent it out, they're trying to create cash flow, but now they're carrying the burden of the second property that they were hoping to cash flow and maybe having a much harder time cash flowing it. All of these things, Kirk, when you start looking at, the husband chart, you start looking at where we are, all of the valuations of markets are tied to a positive outlook of where the economy could go. And, prices are based on optimism and where we think things could be. But all of those things require a continual flow of capital through the economy. And we are tightening things down and people are running out of it. And those, again, they're just data points. I'm not saying run for the hills and panic, but if you're watching things, this is a time to not necessarily continue to see things in a greedy place. Doesn't mean do anything drastic, but begin to watch it very, very closely, because there's a lot of data points adding up that just say, hey, things aren't as rosy as they'd love to show you on S&P. The last thing I'm going to say is when we talk about, that negative 7% 10-year forward return on the markets, this is another clarification that, a lot of confusion. We'd love to use the S&P 500. Everybody does the S&P 500 as the markets. It's not saying that you're going to make no money anywhere for the next 10 years. But what it's starting to tell you is that if you're looking at where the best places to put your money for the next 10 years, there is more than likely going to be other areas that are going to be a better risk-adjusted opportunity for your money than the simple and, highly replicated statement, just throw your money in the S&P 500, because that does not necessarily look positive and rosy for the next decade. And we've talked about how 2000 to 2013, the S&P 500 was negative. Doesn't mean there weren't other markets in asset classes that made money during that time. But this is going to be another reason why diversification, or constantly monitoring from an active position where the best place to put your money, are going to make more sense than just passively throwing it in the S&P.
Great. Well, Doug, where can people find more about you? Let's wrap it up here in the interest of time so I can go off and enjoy my weekend, and you can too.
Same to you. Well, when I start seeing $1,000 payments hitting people's budget, when I start seeing $500, heck, for many families out there, even an additional $100 in debt service is a very, very painful and potentially unsustainable place to be. Look, it's college. And we're talking about student loans. That came from college debt. Talk to people every day. Colleges are expensive. People are, the discounts are out there. 85% of families apply to the same 50 schools and then wonder why they're not getting tuitions. I saw a stat the other day. They were proud of the stat. A number of kids that had gone through this program and gotten these scholarships, and they'd gotten these, that hundreds of $1,000 scholarships. When I did the math, it was like $10,000 a family. That's not that much when you're talking prices $30,000, $40,000, $50,000 a year. There's plenty of money out there, great opportunities. It's about the outcome. And if you're concerned about the cost of college, if you're concerned about the outcome for your child going through college, if you want to make sure that they're going to have an extraordinary future, do it right, because you can't go back and do it differently later. And if you want to get some more information on how to circumnavigate this really complex and very high pressure and scary college world, get some information, procollegeplanners.com, on our website. Talk, and if it need to, talk to us, get some questions answered, because there is a better way.
Awesome. Well, Doug, really appreciate you joining us. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.